What's going on, guys? Welcome back to the fourth episode of the Q&A show that I've been doing for the past couple weeks. I took a week off just because I had some other stuff to do, but wanted to get back on it today. It's about 9 o'clock, so I decided to stay in the office late, get it done, bang it out, and hopefully I'll get it up tomorrow, being Friday. Just some good news. We had that deal in Columbus. It looks like we're going to go ahead and do it after doing the due diligence. Definitely some stuff we weren't prepared for, but luckily enough, we had enough of a contingency in our budget that we should be able to shift some money around, and a couple things came in under budget that we thought were going to be more. So all in all, looks like it's going to be a project we are going to go forward with. So we're now in the process of raising money, so it should be fun. But, we sold the deal not too long ago. A lot of our investors indicated that they wanted to roll all or part of their money into it, so hopefully should get a lot of stuff done. Hopefully we'll be closing that, in the next month or two. And we're looking at some new deals. Hopefully we can buy one, before the end of the year and kind of wrap up. Really nice end to the year. On some other notes, I'm really curious if anybody watching this is going to the Bigger Pockets conference. I got an alert for it. I guess this is the first one they're doing, so I'm really interested who's going, what you think about pricing. So if you're watching this video and you're thinking of going, reach out to me on, by email, chris@tororep.com, through Instagram @grenzigcre. Let me know if you're going, why you're going. If you're not going, let me know why you're not going. Curious to see what people are thinking. I'm also thinking I'm going to start looking for some other conferences to start going to more. I just think it would be good to get out and see kind of what people are doing, meet some more people. So if you are going to a conference in the near future, please tell me about it. I would love to hear where people are going. If a bunch of people are going to be there, a bunch of you are going to be there. Would love to meet you, love to sit down face-to-face, get some FaceTime with everyone, as well as if, you're an owner as well, would just love to, meet, be a resource for each other and see if, sometimes there's synergies you don't know about and maybe we can, make something work. So definitely reach out to me. Let me know where you're going, why you're going, and I'll definitely look into it. But with that, we're going to jump right into it. We're going to get into the first question. This was from Instagram, and it goes as, I'm a guy in my late 20s who has saved up 30 to 50K and wants to get into real estate. I have a mortgage on my personal house. I know a fair amount about real estate. Have a bunch of friends in construction, some with some rental properties, but would still be considered a newbie compared to someone like you. If I want to get into the game, which direction should I go in? On the one hand, a buddy and I were thinking of building a house from the ground up, about $250K in with land. He's heavy in construction, so rough estimates are somewhat accurate, and flipping for $350. We're also thinking of doing a duplex, more upfront cost, but better on the flip or even long-term rent out. The other part of me was thinking of just buying a townhouse and renting it out long-term, but the return on that takes a long while. So I don't know if you were in my spot just starting out, which route would you go with the knowledge you have now? Really awesome question. I got this, probably about a week ago, and I saved it because I did want to talk about it. First thing of note, I've been speaking a lot about house hacking, with him owning his own house already and probably knows about it. I'm not going to include that in this. So if you were going to go beyond that, ground up, there's a lot of risk involved. It's really fun. It's really sexy. And I would love to do more of it just because I think it's super cool and it's something I would like to invest in personally. But there's a lot of risk involved. Now, if you've got a friend that is, building houses for his company, month after month, year after year, and really has a good handle on these things, it could be very interesting. What I'll say, though, is it does change from, being on the construction side and putting things together to now, analyzing a deal, making stuff work, right? When you're building something, you got to account for interest reserve. You got to look at contingencies. There may be some other things you don't want to account for, right? What's the proper cost of capital if you're not going in all cash? What does a loan cost? You got to understand that. How does the draw work? You got to have those connections. You got to also have a personal track record to be able to go out and get that. Just because you have a construction background and you own a home doesn't mean you're just going to necessarily be able to go out there and get a construction loan, regardless of whether you have the right, financials, net worth, liquidity, debt to income ratios if they need it. you gotta make sure you have all that stuff lined up before you just decide to go build. It's not a bad option by any means. It's a very good option. It's not something I would personally be able to do because I don't have somebody with that background, and it's probably something I just personally wouldn't do. It's a little too risky for me, and I think we're towards the top of the market than the bottom, and I think there's a growing trend of rentals, so it may not be something I would do. Now, building a duplex or building rentals is something I would love to do personally. We were just talking about this at the meetup last night. If you didn't watch it, I'll be putting the video up soon. And I was talking to a guy who's building, I think, like a 30 unit somewhere in Long Island. I said, honestly, the ideal scenario for me is if I had, tons of money or, unlimited funds, or, I didn't need to make tons of money. I would love to build something and hold it for 30 years. And the reason for that is, one, you get to build something which I think is very cool, and you have an ability to create a ton of value from, buying land. The other part of that is when we go out and we buy deals, you buy it from the 60s, 70s, and 80s, there's only so much you know about what you're buying. You really don't know what you're buying. You don't know how it was built. You don't know if somebody cut corners. You're not opening all the walls to see if they use a certain type of, wood, nuts, shit I don't even know about. You find out it's built from wood frame or from concrete block, and, they use, a little bit. But when you build something yourself, you know exactly what the fuck you're doing and what you actually have. We do the best that we can with the resources we have available to us. But if you build a property or you buy a property that somebody else built, especially if it's been traded a few times, if you buy from an original developer, maybe you get the full story, maybe you don't, really depends. But you're going to know that thing like the back of your hand. You're going to be able to take care of that thing really well. You're going to be able to run it super lean going forward. So being able to build something and hold it for a long time, I think creates a lot of that value up front. You can probably get a good loan afterwards and pull out a lot of the equity that you had, maybe even all of it, depending upon how long you do it. If you hold that thing for 10, 15, 20, 30 years, at some point, just the way real estate tends to go, it's going to appreciate enough that you're going to pull out all your equity and you could then go do it again. So, it takes money to kind of do that. If you don't have a ton of money, developing and selling will net you more money in your pocket quicker to build up a nest egg to go do that. But if you already have a substantial size nest egg, I would definitely build and hold for the long term, because I think it's just the most risk averse if you know what you're doing, and hopefully you do, and you'll know the most about that property than you ever will compared to anything else. So if we're talking about building, I would go for the duplex and I would hold it, and I would try to refi out as much as I can, and then see if I can save up some more money, and then just continue to repeat the process. Outside of that, I think other really good strategies, as much as it's not as sexy, starting today and building up rentals, if you can chunk off, $30,000 to $50,000 every couple years, that money is going to build over time and build interest over time. So it may not make you a millionaire by the time, you said late 20s. So, it may not make you, a millionaire by the time you're 40, but it'll probably make you a millionaire by the time you're 60, 70 years old and you're looking to retire or you're looking to create generational wealth. So if you have a much longer term view, I would definitely consider rentals, even if it's not a, significant short-term gain, as a really great avenue, whether it's multifamily, single-family homes, etc. And you can always then pivot, or you can allocate your money between two different things, right? Play both sides of the coin. Go super aggressive on development of single-family homes. Take some of that money and, buy a couple rentals every year and go long-term as well. So that way, you're getting the super aggressive to try to build a nest egg, and then you're also getting the rental side and going long-term and a little bit more risk-averse. On to the second question. This one's taken from Bigger Pockets. Hi, all. I'm interested in passively investing in large apartment deals. I already have connections to a few operators and have browsed their packets but haven't pulled the trigger yet. Does anyone have any recommendations for educational resources, books, podcasts, courses, etc., for how to vet the operator and the deal itself? I understand the math, but need more information on what to look out for as red flags. Seeing returns of around an 18 IRR for a 5-year hold. Is that in line with what most are offering? Thanks. So I'm not going to give resources. I'm just going to be the resource and try to talk about some of the things that I think you should look for if you're going to be a passive investor. The biggest thing for me is you don't want to only underwrite the deal itself. You want to underwrite the person operating the deal. A deal is only as good as the person that's operating behind it. And the biggest way to underwrite somebody that's doing it is to take a look at their track record. Have they bought deals? How many deals have they bought? Have they sold deals? Right? Just because anybody can go out and buy a deal, right? Just because a deal is on the market, and just because you have the money, if it's a 6-cap market, I can buy any deal for a 2-cap. So I could go buy 30,000 units tomorrow if I wanted to, just pay double what everything's worth. So just because somebody has bought a lot of deals doesn't mean they're a good operator. So understanding what their track record is, how did they operate? How did they operate against their projected budget, right? Did they come in line with their projections on income? Did they come in line with their projections on expenses? If they didn't, why didn't they, right? Oftentimes we have deals that, we might be low on income or, high on expenses or vice versa or a combination of the two, but there's a very good reason for it. One of our deals that we did very well on, we were super low on expenses. So all we did was, instead of continuing a renovation plan, we continued to implement the RUBS, and we just kept occupancy super high. We didn't need to push income because our NOI was there, and it served two purposes. One, we hit our NOI threshold, which we thought would make us a really good return. And two, because we knew we could probably push income a little bit more, it protected us in the future for cap rate movement in, a softening market. If there's a ton of meat on the bones, someone is going to continue to pay low cap rates despite what the market is doing. So, we just continued to analyze where the market was going and how this deal was doing. Instead of really trying to push and take a risk and a gamble, we kept occupancy really high at 97, 98%. So if somebody saw that deal as, verifying us as operators or sponsors, you might say, well, you guys missed on income, but that was conscious. That was something we decided to change because we felt it would still work. Some other things I would look for is the assumptions people are doing when they're underwriting. A big one is comparing the actual expenses for the prior year or prior 2 years versus what they're doing going forward. A big one is taxes. Understand what is happening with taxes. A lot of places will reassess on sale, but some won't, or some have a significantly smaller reassessment. Some have a significantly bigger, like Columbus, Ohio. People just get, brutalized on new acquisitions because they go to 100% of reassessment instead of like 60, 70, or 80. So it swings way higher. Some places like North Carolina, they do it every, I think it's 4 or 7 years. I forget exactly. So it may have just been reassessed and you've got another 6 years until it goes up. So I want to look in year 6 or year 7, I guess, year 6, whatever it is, and make sure that the taxes are going up and that I understand what level they're going to. So that's a big one. If they're cutting expenses, right? If, let's say, repairs and maintenance was $100,000 and they're dropping it to $80,000, why is that happening? They should have a reason for that. It shouldn't just be, well, that's the market. Well, yes, but, in the market, there's some that are high and then there's some that are low. So you got to understand, is this just one of those ones that operates highly because it was built poorly, right? Going back to what we were talking about, building a property and really knowing it. This deal just could have been built very poorly and needs more repairs. Just if anything is cut, they should have a really good explanation for it. If they just said, well, this is the market, that's for me, not a good enough reason. Other things I would look for is, percent increases on assumptions. Every year we'll assume that income and expenses are going to go up X percent. So inflation, we usually say, is 2%. But if we're in a market, like the Floridas, we may assume 3 for income, 3 for expenses, 2.5 for expenses. And the reason for that is because there's a lot of job, wage, population growth. The past 2 years, it's been something more like 5-6% per year, but we've only underwritten to 3. So we've actually gotten additional rent growth than what we projected. So, taking a look at what those are, and if it's not provided, do the math and figure it out yourself. If somebody's got 6% growth for the next 7 years, that's probably not happening. It may not want to be a deal you're going to do. I would ask for, what does it look like at 2, or at 3, or at 4, and just seeing how you feel. Other things I would look for is the cap rate that they're selling at versus the market today, or what they're buying it at. If somebody's buying at a 7 cap and they're selling at a 5.5 cap in 3 years, I would be very leery of that deal. Unless the market is a 4.5 cap and they're just getting a crazy stupid deal, well, then that makes more sense. We always look for deals that bake in some conservatism in the cap rate. So if the market today is a 5.5, don't underwrite to a 5.5, because if the market shifts in 3 years, you're going to be stuck holding the bag and you're not going to hit your return. So underwrite to 5 3/4, a 6, 6 1/4, 6.5, whatever makes you feel comfortable. I would look for CapEx budget. I personally like to put in a contingency just in case, things happen, things come up. You want to have additional capital needed. The other biggest thing that I didn't mention, when you are investing with somebody else and you are giving up control in that deal, one of the most paramount things I would look for in an operator, in a syndicator, is their co-investment. Are they putting their money where their mouth is? Are they having skin in the game? Because if that deal does not go as planned, somebody with no money in that deal is not going to work nearly as hard as if they're investing 5, 10, 15, 20% of the equity. And I would also look at, typically deals will have an acquisition fee. Are they investing above and beyond what that acquisition fee is, or are they just rolling all that money into it and really it's, they're getting compensated with equity and it's not really skin in the game. It's fake skin in the game, whatever you want to call it. So that's another thing I would really look at. Does this person have skin in the game? Are they going to work hard for their money as well as mine? Are our interests really aligned is what you're really looking for. When you are investing with someone as a syndicator, an operator, fund manager, whatever, the closer you can take your interests and their interests and put them together, the better off that investment is probably going to go, because people just work for their interests. That's how it works. If you do not have money in a deal and it's going sideways, it just flat out fucking sucks. So those are some of the things that I would look for if it was me, without going on a 30-minute tangent. Last question. Hey, bro, we're the same age, and I've grown up in residential real estate. I'm licensed. Long-term, I want to work with investors, apartments, and help people grow their net worth and set up generational wealth. Long story short, I'm looking at getting a degree in business, real estate/finance. I'm online right now, and then it hit me, ask Chris. Which concentration in business would be ideal to do what you're doing now? Appreciate the help. I'm in Irvine, California, huge Fortune 500 companies here. I saw some sick entry-level positions being a real estate analyst. And just wanted to clarify, was it undergrad or a grad degree? And it was undergrad. I have not used my college degree once. I guess technically I did. I was a Division II coach, and they wanted to see a bachelor's degree, but they didn't care what the school was or the degree. They just really wanted to see that you had one. After that, I became a cold caller at a stock brokerage firm. There's plenty of people there that did not have a college degree. Not that it really mattered. It was a sales job. It was cold calling. It was not a requirement for that company. When I moved into flipping homes on the side, that was me starting and failing at a business. And then when I moved to Toro, maybe they wanted to see one, but they didn't care that it was from Hofstra. They didn't care that it was really in business. I was brought in and coached up into the business. So for me personally, I really haven't used my degree to get a job. Now, it may have been a hurdle that people were looking for, but it really hasn't done anything for me. As far as classes I took, maybe some of the classes that I had gave me some sort of background or basic understanding, but it's not like I'm sitting here saying, oh, thank God I took Finance 101, because I use that calculation all the time, day to day. It just doesn't happen. So for me, it hasn't helped. But if, like he mentions, Fortune 500 companies, a lot of bigger companies still want to see degrees, and they want to see that you're educated for good reason, right? If you do go to school, you probably have a better base than someone who doesn't. Not saying it's true, not saying it isn't true. It's just more likely than not if you're playing the averages. So if that's your route and you want to go into, the corporate world, you want to go work for a Blackstone, they're probably going to require you to. I would encourage you not to go to a super expensive school. I would encourage you to go to a state school, community college, because I think those work equally as well as compared to the schools that are not the top 15, right? There's a difference between a Hofstra and a Harvard, but I don't think there's a difference between, Hofstra and I don't even know. What's a not top 15? I don't even know how this shit works, honestly. But, if you're a top 15 school, MIT, Harvard, whatever, they are viewed differently. If you're not, I don't personally think there's a huge difference. But if you were stuck on going to school, I would look for, and you were set on real estate, I would find a school that has a real estate major. You are going to learn things that I have learned over the past 3 years in those classes, and you may get taught by somebody who knows more than I do. So I would definitely encourage you to find a school that has a real estate major or minor, if not a whole separate program. And then I would meet every single faculty member in that area and have a conversation and be a contact with them. If you weren't going to go to school or you wasn't sure it was necessary, I would reach out to 100, 150 of those companies that have a real estate analyst position and find out if you can, one, get a job without a degree, and two, how to go about doing that. The more people you contact, the more likely you are to get a job. So if you're going to school to get a job, my recommendation would be to reach out to those people first, because you may save yourself a hell of a lot of money just by asking first. So if you were set on going to school, I would look for a school with a real estate major, minor department. But I would highly recommend you reach out to those companies first, before spending tens of thousands of dollars and putting yourself in the hole, unless, you're fortunate enough to have that money readily available. So that's it. That's the show for this week. Hopefully you got some good stuff out of it. I think the passive investing is something I want to talk about more in the future, because I think it's an area that a lot of people don't understand as well, or don't know what to look for. They just see the numbers and the returns, and they get, shiny object syndrome, not every operator, not every underwriter is created equally. I can very easily take a deal that is not good and make it look good just by shifting around some numbers and playing with things. And vice versa, I can take a deal that looks very good and get way too conservative and butcher the shit out of it. So understanding the mechanics behind the deal is going to help you analyze the deal further and feel real confident. But just going back to that real quick, track record and past performance and hitting. Just because some return a 30 IRR doesn't mean they know what the fuck they're doing. It means they may have just timed the market right. Most people, if you bought a deal in 2012 and you sold it in the last 3 years, you probably made a very ridiculous return, because cap rates were 200 basis points higher than they are today. 5 cap market today was probably a 7 cap, maybe 6.5 cap, whatever. Anybody can almost buy a deal back then and make a ton of money now. So for me, past returns aren't the best indicator. Looking at how they budgeted that property, and then look at the issues that came up while that property was occurring, and seeing how they worked around those issues, seeing how they met the budgeted expectations, is significantly more important than I made, all my deals have done a 30 IRR or better. That's great. But nobody's really getting help by cap rates anymore. I don't think they're going down much further. They're probably as pretty low as they can go, to be perfectly honest. But that being said, I may look for more questions in the future, or, I'm honestly debating about doing like a little mini series on, what to look for when you're looking at a passive investing book or deal or something of that nature. So If that's something you're interested in and you guys like that, definitely let me know. I definitely tend to stray more towards where good feedback is. I'm still going to do what I want to do and talk about what I want to talk about because it's my time and I want to talk about the things I want to talk about. But, if I have 12 choices and I'm picking 3 and I know of those 12 people really like these 3, I'll pick those 3. If there's something you want to talk about or a question you have, please drop it in the comments below if you're watching this on YouTube, or hit me up by email, chris@tororep. Find me on Instagram, grenzigcre. Just let me know what your question is or something you want me to talk about, or a topic you really think would be interesting. I can always go out and find questions. That's easy. I always forget to do a plug in the beginning, but if you are watching this video and you got this far, thank you very much for watching. It would be awesome if you would hit the subscribe button below, maybe give a thumbs up as well. Both would be really cool. I'm not super concerned about that stuff, but it'd be nice as well. So, drop a like, drop a subscribe, drop a follow, drop a comment. I don't know what the shit is, but do something for me, please, if you liked it. But that's my show. Thanks for watching.